Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive into.
All right, today we're going to tackle something really, really fundamental. I mean, if you're trying to build wealth, trying to secure your future, it's how taxes hit your personal investments and maybe even more importantly, your retirement plan.
Yeah, it's a huge topic, right? And lots of layers. We've looked at quite a few things, everything from, basic investment ideas like stuff you'd find in the Boglehead's Guide to Investing, all the way up to these really high-level discussions on U.S. tax policy, the international stuff, things debated in, say, Senate Finance Committee hearings.
And look, our mission here isn't to suddenly make you a CPA overnight, right? Or some kind of tax policy expert.
Definitely not.
It's more about pulling out the really important pieces, the insights you actually need so you just feel a bit more clued in about how taxes work with your money, your investments, and sort of the bigger economic picture they shape.
Yeah, how it all connects. So let's just jump right in. You're investing, maybe putting money away regularly. Why is getting even a basic handle on tax laws so crucial? I mean, beyond just doing your tax return once a year.
Well, because taxes are honestly one of the biggest factors affecting your real return, what you actually keep.
Right.
If you ignore how taxes work with different investments or how you manage them, you're basically just leaving money on the table. Potential growth, future wealth, just gone.
And even if you hire someone, a tax pro, which lots of people do, knowing a little yourself makes those conversations way better, doesn't it?
Oh, absolutely. You can ask smarter questions. You actually understand the strategies they're suggesting. You're making decisions with them, not just handing it all over.
Right. You're part of the process, not just like showing up in April with a box of receipts.
Exactly. You're an active participant.
Okay, so basics. The U.S. has this graduated income tax system, right? Different rates for different income levels. But for investors, you often hear the really key thing is the marginal tax rate. Why that specific rate?
Because your marginal rate, that's the tax rate on your next dollar of income, the very next one you earn.
Okay.
And that's critical because it directly tells you the after-tax return of adding certain investments. Like if you're thinking about buying a bond that pays taxable interest, your marginal rate tells you how much of that interest you actually get to pocket after Uncle Sam takes his share.
So it helps you compare things like taxable versus tax-free.
Precisely. That marginal rate is often the deciding factor between, say, a regular corporate bond and a tax-free municipal bond.
Okay, that makes sense. It's about the impact of adding more. So let's break down how different investment income gets taxed. Dividends first. What's the deal with those?
Well, it kind of depends. There are qualified dividends. These usually come from U.S. companies or certain qualified foreign ones. The big deal is they get taxed at lower rates than your regular income.
Lower rates, how much lower?
Often it's between 5% and 15%, depending on your overall income. That's usually a pretty significant saving compared to your top marginal rate on, say, your salary.
But you said qualified, so not all dividends get that sweet deal.
Correct. You also have ordinary dividends. These might come from things like REITs or some other types of investments. They're taxed at your regular income tax rate, just like your job earnings.
Okay. And how does a dividend become qualified? Is there a catch?
There's a holding period rule. You generally need to have owned the stock for more than 60 days during a specific 121-day period that starts 60 days before the day the stock trades without the dividend attached, the ex-dividend date.
Okay, so a bit fiddly. You need to pay attention to timing if you want that lower rate.
Yeah, it's something to be aware of, definitely.
What about mutual funds? They pay dividends too, right? How does that work?
Right. Mutual funds pass through income. They can distribute both ordinary and qualified dividends. You'll see it broken down on the 1099 DIV form you get for your taxable accounts.
Okay.
But here's an interesting quirk. Capital gain distributions for mutual funds. Those are treated as long-term capital gains for you, even if you just bought the fund last week.
Really? Regardless of how long I held the fund?
Yep, as long as the fund held the underlying stocks or whatever for over a year before selling them for a profit.
That's good to know.
Yeah.
But it also sounds like it could lead to that issue people warn about in taxable accounts. Buying the dividend.
Exactly. That's a potential trap.
Explain that. Why is it bad?
Okay, so imagine you have a taxable brokerage account. You see a mutual fund is about to pay out a big distribution, maybe dividends, maybe capital gains. You buy shares right before that happens.
Okay.
You get the distribution, which is nice, but
Yeah.
it's immediately taxable income to you. And right after the fund pays out, its share price usually drops by about the same amount.
So I paid full price, got some cash back, but now I owe tax on that cash.
Yeah.
Even though the fund value just dropped.
Precisely. You haven't actually gained anything new. You just got a piece of the fund's value handed back to you and triggered a tax bill in the process. It kind of erodes your immediate return unnecessarily.
Doesn't sound great. But this isn't a problem inside retirement accounts, right? Like an IRA or 401k.
Correct. That's one of the huge advantages. Inside those tax-advantaged accounts, distributions happen, sure, but they don't create an immediate tax bill for you. The taxes are either deferred way down the road until you withdraw in retirement,
Or maybe never with a Roth.
or potentially eliminated altogether with qualified Roth withdrawals. So yeah, buying the dividend, not a worry inside those accounts.
Okay, super clear. Dividends covered. Let's shift to capital gains. Probably the one people think of most with investing. Sell something for more than you paid.
Yeah.
How does the tax work there?
The absolute number one factor. How long you held the investment before you sold it. That's everything.
Because that decides short-term versus long-term.
Exactly. And
Yeah.
the tax difference is significant.
That's significant.
Okay, hold something for 1 year or less, sell it for a profit, that's a short-term capital gain, and it gets taxed at your ordinary income tax rate.
Same rate as my salary. Or those ordinary dividends.
Yep, same rate, which for a lot of people is much higher than those qualified dividend rates we just talked about.
Right, so the alternative.
Hold the investment for more than 1 year before selling. That profit is a long-term capital gain, and those get the special lower tax rates. Usually, those rates align with the qualified dividend rates, 0%, 15%, maybe 20%, depending on your income. Much better than ordinary income rates.
So holding for like a year and a day can literally save you a chunk of money in taxes.
It absolutely can. Big incentive to be a long-term investor, tax-wise.
Does this apply to everything? Stocks, bonds?
Mostly stocks, bonds, mutual funds get those standard long-term rates. But keep in mind there are some wrinkles. Long-term gains on things like collectibles art, gold, jewelry, they actually get taxed at a different, potentially higher maximum rate than stocks.
Okay. Nuances. So if you're buying and selling different things at different times,
Yeah.
how do you possibly keep track of what's short-term, what's long-term?
Yeah, good record keeping is key. Or using decent tax software. Brokers usually track your purchase dates and cost basis now, which helps immensely. When you file taxes, you'll use something like Schedule D. It's a worksheet that helps you list out each sale, classify it short or long term, calculate the gain or loss, and see how it all nets out.
Okay, sounds like you need to be organized, or have software, that is.
Definitely helps.
All right, dividends, capital gains. What about interest? Like from bonds or CDs, is that always taxed?
Generally, yes. Interest you earn from things like corporate bonds, U.S. Treasury bonds, even bank savings accounts or CDs, that's typically taxable income.
And taxed at my regular rate.
Usually, yes. Taxed as ordinary income. Which brings us back to that marginal tax rate calculation again.
Right, comparing taxable bonds to tax-free ones.
Exactly. If your marginal tax rate is high, a municipal bond paying, say, 3% tax-free might actually give you a better after-tax return than a corporate bond paying 4% taxable. You have to do the math based on your own rate.
Makes sense. Got to look at what you keep. And interest earnings really highlight that amazing power of compounding, right?
Oh, massively. It's maybe the most powerful force in investing. Think about it simply. $10,000 earning 5% interest. If you just take the $500 interest each year and spend it, fine, but your principal stays at 10K.
Okay.
But if you reinvest that $500, now the next year you're earning 5% on $10,500, not just $10,000.
So you earn interest on the interest.
Exactly. And that extra $25 the second year might seem small, but over 10, 20, 30 years, that interest earning interest, it snowballs, the growth becomes exponential. That reinvested $500 per year example, it adds thousands more over the long haul compared to just taking the interest out.
It's that snowball effect that really builds wealth over time.
It is, and there's a quick rule of thumb for this, the rule of 72. Heard of it?
Vaguely. Yeah. How does it work?
Super simple. Just divide the number 72 by the annual interest rate your investment is earning. The result is roughly how many years it'll take for your money to double.
That's a gavel.
Sure. Say you're earning 7% per year. 72 divided by 7 is about 10.3. So your money doubles in roughly 10 years. If you're earning 10%. 72 divided by 10 is 7.2. Doubles in just over 7 years.
Wow. So a few percentage points makes a big difference in doubling time.
Huge difference. It really drives home how higher returns, fueled by compounding, accelerate wealth building. And it underscores why starting early is just so incredibly powerful, especially for long-term goals like retirement.
Yeah, let's talk retirement, because that rule of 72 combined with starting early. That's where the magic really happens, right?
Absolutely. And the whole retirement saving game in the US has changed so much. It used to be more about company pensions, defined benefits. Now it's largely on us, the individuals. We have to fund and manage our own 401k, IRAs, that sort of thing.
Which makes understanding and using those tax-advantaged accounts properly even more critical.
Indispensable. They are your best friends for long-term saving. Like we said, they shield your dividends, interest, capital gains from taxes right now.
Letting them compound tax-deferred or tax-free.
Exactly. Either deferred until retirement in a traditional account or potentially tax-free forever in a Roth. That issue of buying the dividend, total non-issue inside these accounts.
And that combo, compounding plus tax advantages, makes starting early almost unbelievably impactful. There's that classic Bogleheads example, right, Eric and Larry?
Yeah, it's a great illustration. So Eric starts investing $4,000 a year at age 25, but he only does it for 10 years, stops at 35.
Oh.
Total invested, $40,000.
Okay, just 10 years of saving.
Then there's Larry. He waits until he's 35 to start, but he invests $4,000 a year for 30 years straight, right up to age 65. Total invested, $120,000.
So Larry invested 3 times as much money as Eric. Who has more at age 65, assuming they both got, say, an 8% average annual return?
Eric, by a lot.
No way, even though he put in way less.
Yep. Eric's $40,000, because it had that extra 10 years to compound before Larry even started, grows to over $629,000 by age 65. Larry's $120,000. It only grows to about $489,000.
Wow, that is stunning. Just that 10-year head start made that much difference.
It's the magic of compounding over long time horizons. Time is your greatest asset when investing.
So, start early. That's lesson number 1. What other core investing principles came up in the materials? Things that apply no matter what.
A big one is maintaining perspective. Long-term discipline. Don't panic and sell when the market gets volatile. That's usually the worst thing you can do. Stick to your plan.
Easier said than done sometimes, but crucial.
Definitely. And simplicity. Keep it simple. Successful investing isn't about finding some secret complex strategy. It's often just doing a few basic things right, consistently, and avoiding big mistakes. Simple, low-cost index funds, for example. Very effective.
And what about risk? How should that change over time?
Generally, yeah, it's wise to dial back the risk as you get closer to needing the money. So as you approach retirement, you might shift gradually from mostly stocks to a higher allocation of bonds or safer assets. Protect what you've built.
Makes sense. So beyond the investing part, what about the broader retirement planning? People talk about finding your number, how much you need.
Right, you hear rules of thumb like needing 70% or 80% of your pre-retirement income. They can be useful starting points, maybe, but you gotta recognize their limits.
How so?
Well, they make big assumptions, like, will you really spend the same amount at 85 as you do at 65? Probably not. Health changes, activity levels change, and those simple formulas. They can't predict life's curveballs, a market crash right when you retire, unexpected health costs, job loss before you planned.
So they're rough guides, not gospel.
Exactly. A more actionable focus is often just on your saving rate. How much are you actually putting away? Aiming for 15% to 20% of your gross income is a common target. Maybe more if you want to retire early.
In a practical way to get there.
One good strategy is, anytime you get a raise, dedicate that increase or a big chunk of it directly to boosting your savings rate before you get used to spending it.
Smart. And the flip side of saving more is spending less, right? Mm-hmm. Controlling expenses.
Absolutely. And that's something you have almost total control over right now. Really figuring out wants versus needs. Budgeting, tracking where the money goes. It sounds basic, but it frees up cash flow you can then invest.
What kind of things make a difference?
Getting rid of high-interest debt, like credit cards, is huge. Cutting back on things like eating out all the time, maybe that extra streaming service. Even bigger things like choosing a more modest car instead of a luxury one, saves on payments, insurance, gas. All that saved money can go towards your future.
Are there specific things people do right before retirement to cut costs?
Yeah, if the timeline is tight. Maybe delaying retirement a year or two, that gives investments more time to grow, and it's one less year you need to fund from savings.
Right.
Paying off your mortgage aggressively eliminates that big monthly payment. You can look at adjusting insurance, higher deductibles maybe, dropping collision coverage on an old car, reevaluating if you still need as much life insurance if the kids are grown and gone.
And lifestyle choices themselves play a role too.
Big time. Healthy living, not smoking, exercising. Moderation, that can mean lower healthcare costs down the line, which is a huge retirement expense. And sometimes people make a big move, like selling a large house in an extensive area and moving somewhere cheaper. That can free up a lot of equity and lower ongoing costs like property taxes.
But even with the best plans,
Yeah,
life happens. Right.
for sure. The sources mention, a lot of people end up retiring earlier than they expected. Maybe health problems, maybe their company downsizes, maybe they need to care for a parent or spouse.
So you can plan, but you can't guarantee.
Exactly. You plan for the best, prepare for the bumps. Having some flexibility, some contingency is really important. A big market drop right after you retire, or the housing market tanking when you plan to sell, those can be really tough. You need to anticipate potential risks.
Okay, so that's a really solid look at the personal side. Taxing investments, planning for retirement, the power of compounding and starting early. But you mentioned earlier, this all happens within a bigger economic context shaped by tax policy.
Right. And this is where we kind of zoom out. We need to understand a bit about the complex world of corporate and international tax policy, not to become experts, but because it shapes the environment we invest in, the jobs available, the whole economy. We're drawing here from some pretty high-level discussions, like those Senate Finance Committee hearings.
What was the main issue driving those particular discussions?
A big catalyst was a World Trade Organization ruling. The WTO said a specific U.S. export tax benefit wasn't allowed, so the U.S. had to repeal it. That forced Congress to look hard at the whole system of how the U.S. taxes international business. And some voices were saying the U.S. rules were just old, outdated, not keeping up with how global business works now.
How does the U.S. system compare to other countries when it comes to taxing international income?
That's a really key difference. The U.S. traditionally has taxed the worldwide income of its companies. Now, they do get credits for taxes paid to foreign governments to try and avoid double taxation. But many other big economies have shifted to what's called a territorial system. Basically, they say, if you earn profits actively in another country, pay tax there. And that's mostly it. We won't tax it again back home.
So the argument is the U.S. system makes U.S. companies less competitive abroad.
That's exactly the argument some people make. They say U.S. companies face a higher tax burden competing overseas against foreign companies operating under territorial systems. It creates pressure to change the U.S. approach.
So what specific parts of this complex international tax system cause the most debate?
Well, one huge area is those foreign tax credits, the FTCs. The idea is simple: avoid double tax. But the rules for calculating them, applying them, they're incredibly complicated. You have to sort income into different baskets, follow detailed rules.
Sounds messy.
It can be. And sometimes, because of the complexity, companies can't actually use all the credits for foreign taxes they've paid, which means they do end up getting taxed twice on some income. So lots of debate about simplifying those rules, maybe reducing the number of baskets, letting companies carry unused credits forward for longer.
What about rules trying to stop companies from just hiding profits offshore indefinitely?
Right, that's where things like the Subpart F rules come in. They were designed decades ago to say, okay, certain kinds of easily movable foreign income, we're taxing that now, even if you don't bring the cash back to the U.S. It was meant to stop tax avoidance. But critics argue that sometimes these rules end up hitting legitimate active business operations abroad. Like maybe a U.S. company sets up a central warehouse in Europe to serve customers there efficiently. Subpart F might, in some cases, tax the income from that warehouse currently, potentially putting the U.S. company at a disadvantage compared to a European competitor doing the exact same thing.
Unintended consequences. You mentioned Section 956 too.
Yeah, that's another anti-abuse rule. It basically says if a foreign subsidiary of a U.S. company invests its money back into certain U.S. assets, like lending money to the U.S. parent, that can be treated as if the foreign sub paid a dividend, triggering U.S. tax. Again, meant to stop games, but some industries, especially financial services, argued it could cause problems for perfectly normal business transactions.
And earnings stripping, what's that?
That's mainly about foreign companies operating in the U.S. It refers to rules that limit how much interest deduction a U.S. subsidiary can claim on loans from its foreign parent company. The concern is that companies might load up the U.S. sub with debt and strip earnings out of the U.S. tax base via interest payments.
Okay, so tons of complexity. What's the bottom line argument about how all this affects U.S. competitiveness and maybe more importantly for many listeners, U.S. jobs? It sounded like there were different takes.
Definitely different takes. One view is pretty clear. these complex, potentially outdated international tax rules. They actively hurt U.S. job creation and depress wages here. The argument is that if the tax code makes it harder for U.S. companies to compete globally or encourages them to move operations or even headquarters elsewhere, that costs U.S. jobs.
Yeah, that makes intuitive sense. But what's the counter-argument?
The other side, often voiced by business groups and sometimes Treasury officials, is that helping U.S. companies be more competitive internationally actually helps create jobs back home.
How does that work?
The idea is that when a U.S. multinational succeeds abroad, it needs support functions here. R&D, management, logistics, maybe even some manufacturing. A bigger, more successful global company headquartered in the U.S. means more high-value activity here. Allowing them to compete and win overseas enables that growth, which benefits the U.S. economy and creates demand for U.S. exports.
So success abroad fuels success at home.
That's the argument. And they'd point to things like corporate inversions, where a U.S. company effectively reincorporates overseas, often through merging with a foreign one, as proof that the U.S. tax system is driving companies away, and reforms are needed to stop that.
Were there specific industries or examples used to make these points?
Yeah, a couple stood out. The decline of the U.S.-flagged international shipping industry was brought up. Some argued that tax law changes made it much harder for them to compete with foreign shippers who often have more favorable tax regimes. This was framed partly as an economic issue, but also a national security one, relying too much on foreign ships.
Interesting. What else?
The situation in Puerto Rico came up too. A previous tax incentive, Section 936, had phased out. There was debate about a proposed change to help companies operating there through foreign subsidiaries stay competitive. But the debate included questions about whether tax breaks aimed at corporations actually translate into real benefits, like jobs and investment for the people and economy of Puerto Rico.
Right. Do the benefits trickle down?
That was the question. And the banking industry also raised concerns about a specific IRS proposal. They were worried that requiring banks to report interest paid to non-resident foreign depositors would scare that capital away from U.S. banks. They argued that foreign money helps fund lending here in the U.S. The Treasury countered that reporting was needed for tax enforcement and international agreements.
So lots of competing interests and perspectives. Did the sources provide any data to frame this global context?
Yeah, there were mentions of data points like Hewlett-Packard earning an increasing share of its revenue from outside the U.S., just showing how global these big companies are. And also broader trends like the U.S. share of total world economic output declining over several decades. That kind of data fuels the concern about maintaining U.S. competitiveness.
Given all that complexity and pressure, what kinds of solutions or reforms were actually being discussed?
It was a real mix. Some ideas were about simplification and targeted fixes, tweaking the foreign tax credit rules, maybe adjusting Subpart F to better distinguish active business income.
More incremental changes.
Right. Then there were bigger ideas, like a temporary tax holiday or homeland investment provision to encourage companies to bring back trillions in accumulated foreign earnings at a low tax rate. The hope was it would boost investment and jobs here, but there was debate about whether it actually works as stimulus or just rewards past behavior.
And even more fundamental changes.
Yeah, moving towards a territorial system like many other countries have was definitely part of the discussion. And even technical points, like whether value-added taxes, VATs, paid overseas should be creditable against U.S. income tax, similar to how foreign income taxes are treated. That's another area of complexity.
Wow. Okay, that's a journey from the nitty-gritty of how your personal dividends are taxed all the way up to these huge, complex debates about international corporate tax law.
It really is, but let's try to pull it together. The main point is, yes, you control your personal financial decisions, your saving, your investing, your retirement planning, but all of that happens inside this bigger economic system heavily influenced by tax policy.
So understanding the bigger picture gives context.
Exactly. It helps you understand market dynamics sometimes, why certain companies might be thriving or struggling, potential impacts on jobs, and just the overall environment your own financial future is tied to.
So for everyone listening, let's boil it down. What are the absolute must-know takeaways from this deep dive?
Okay, first, you have to understand how different investment income, dividends, capital gains, interest is taxed, especially in your regular taxable accounts. Ignoring this costs you real money in the long run. Know the difference between qualified and ordinary dividends, short-term and long-term gains.
Second.
Use those tax-advantaged retirement accounts. Your 401k, your IRA, Roth versions, if they make sense for you. They are incredibly powerful tools for building wealth precisely because they let your investments grow sheltered from immediate taxes.
Third key takeaway.
Start early and save consistently. That Eric and Larry example says it all. Compounding interest, especially tax-advantaged compounding, is the closest thing to magic in finance. Time is your friend.
Number 4.
Control what you can control. And you absolutely can control your spending. Cutting expenses, living below your means that frees up money to save and invest. It's often more impactful than chasing an extra 0.5% of return.
Fifth.
Discipline. Stay the course. Markets go up, markets go down. Tax laws might change. Don't let short-term noise derail your long-term financial plan. Keep that perspective.
And finally,
recognize that those big, sometimes abstract-sounding debates about corporate taxes, international competitiveness, jobs, they do matter to you. They shape the economic climate, the health of the companies you might invest in or work for. It all connects back to your financial well-being. So here's maybe a final thought to chew on. We've talked about all these complexities, personal investment taxes, huge corporate tax debates, global competition, jobs. Given all that, how does thinking about these interconnected levels shape your own confidence in planning your financial future? And maybe what role do you think tax policy should play in trying to balance encouraging business and competitiveness with ensuring prosperity for individuals?
if you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe, and now W. Don't miss out on the next episode that could change everything for you.